Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a series that aims to focus on the trend lines rather than just the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Hi, this is Kevin Roskam with USA Financial, and this is your monthly trending report for the month of April 2025. You know, every month we look to the trends and we look to different information to feel better about the stock market, or at least to validate our feelings about our investments in the stock market. And today, I have more charts than normal, and I think you can probably understand why. You know, today I really want to talk to the advisor out there. And if you're a client of an advisor, you can certainly listen in and hopefully glean some information from this conversation. You know, at USA Financial, my title is Senior Advisory Business Consultant. And that senior part of my title is what I feel when the market does things like it's done over the last 2 weeks specifically. Because with the gray that you see comes the senior title. This is a time in the market that by my age, I've seen multiple times. The first time that I was concerned with it, that I suppose was an imprint in my mind, was 2001, a recession that started before 9/11 but was intensified by 9/11. The second time was 2008. For me in this industry, the sideways market of 2011 was also a very important memory. And we go on, in terms of history. And so to come to this point in April of 2025, knowing what I know, not because I'm smarter than anyone else, but because of experience, the last 2 weeks of conversations that I've had, whether it's been with advisors or my own clients, has been a time of really quiet reassurance. It's been a time for me to be that person in this industry that I've always wanted to be. The person who has the confidence and the conviction to know, based on past experience, that this too shall pass. And you may sit there thinking, yeah, sure, this will pass, but how will it pass? How much damage will be done before it passes? And of course, those aren't answers that I can give. But to know that as we look forward, we can look forward with some positivity only because we've come through some of these times in the stock market where the phrase was always, but this time is different. Over the years, there's been a popular movement, popular philosophy in the investment industry to talk about behavioral economics, feelings, and how our feelings can disrupt our investments. You've heard me say short-term emotions kill long-term plans. Well, I want to share some charts and graphs with you that are really built by industry experts to help us in the world of behavioral economics. They're meant really to give us the opportunity to reset or control our own emotions and also the emotions of our clients. And so this first chart that you're looking at, the S&P index performance during and after extreme down days. This is not a calendar. So when you look across the bottom, what you're seeing is the different down days over the course of the last so many years. And when you look at this, what you see below the zero line is that terrible day in the stock market. The very next line is what the market did in the following 12 months. Now, past performance doesn't guarantee future results, but what we see is that regardless of the shock of a bad day in the stock market, the market recovers. And often it recovers to the extreme. The largest line is the 1 year later. Now you go 3 years out, 5 years out, even 10 years out. Yes, they're still positive. But the largest growth comes within the next 12 months after that down day. Now this chart is important, as the next couple will be, because it was built by someone who their only style of risk management is diversification. It is be exposed to all things at all times in order to blunt the overall impact of the stock market. Now, we know that diversification in that way, the classic asset allocation model, doesn't always work out so well because seemingly, everything is correlated today. Everything goes down together regardless of industry. But these charts were built to control human emotion, to try to keep our clients invested in the market, even when the market goes down. And so that's where we talk about trying to control behavior of our investors, trying to keep them to stay the course. This is another great chart, the probability of positive returns since 1937. You can see, and it makes sense, the longer you invest in the market, the higher your probability of positive return. Long-term planning. Long-term plans can only be successful if you get to the long term. And that's what this shows. Sure, we can have down days in the market, down weeks in the market. The market corrects. The market moves in cycles. We know that. Before the tariff scare, the market was already correcting. We saw the same thing in 2022. Before interest rates started rising and inflation was, creeping up, the market was already starting to fall. Interest rates didn't cause the market to fall. It could have accelerated it, but the market moves in cycles. And what these two charts specifically are telling us is it's a reminder. One of the things I think that we need to look at is how was our plan set up for us? Did our advisor plan for the market to move in a downward direction? Did our advisor plan for us to experience volatility? Did he say that, or he or she, did they say that in order for you to have a successful retirement, you need to get whatever the market returns? You need to average 12% a year, or 15% a year, or 20% a year? Or did they put a plan in place where you didn't need to experience all of the upside of the S&P to be successful? It's so important when the market does what it's been doing to step back and understand whether or not you can weather the storm. Can you get through this? And if you've had a good experience with an advisor, if an advisor has put a plan in place for you, the answer should be yes. Now, nobody likes loss. But one of the things we talk about is how do we avoid catastrophic loss? And frankly, what is catastrophic loss? For most people, for the money that's exposed to the stock market, a 10% loss is not catastrophic. It's uncomfortable. We don't want to see a 10% loss, But again, when we set up the plan, we planned for a 10% loss, maybe a 15% loss, maybe whatever the number is, because it was long-term money. Risk management, specifically active risk management, is designed to avoid a catastrophic loss, a 50% loss of your portfolio, a 30% loss of your portfolio. That's catastrophic. A 10% loss should not be. And so that's why planning becomes so important. What's the plan? There should have been a plan to experience this sort of market volatility. Now, here's a positive in my opinion. Based on some of the things that have happened over the last several weeks, here are the odds of the Fed cutting interest rates. Now, what this shows is April 1st to April 4th. And you can see something to look forward to, something to be positive about. It looks like, because of the recent market volatility, that the Fed may be decreasing interest rates soon. And so that's something to be positive about. It's something to consider. It's something to be able to take a deep breath and say, okay, if they reduce rates, that will give our chance, maybe our economy, a chance to spur growth. But this slide and the other two slides I showed all have to do with behavioral economics. They all have to do with somehow us being able to get our emotions back under control. Every investment manager out there that relies specifically on asset allocation and diversification in the traditional sense is putting out these charts and graphs, writing papers, doing all of these things to convince you to stay in the market. And over the long term, depending on your age and your time horizon, that's probably the right thing to do. That's where the difference comes with active risk management. That's where the difference between this sort of behavioral economics and psychology and psychiatry of the markets comes into play with what we do here at USA Financial. Because we think it's important for you to stick to the plan. Stick with the investment strategies, because the strategies are unemotionally and in a disciplined way navigating through the volatility that you see. And so what you're looking at on your screen now is an example of an unemotional, disciplined, formulaic approach to determining when to be in and out of the market. Now, this is one of the very long-term indicators that you may have access to depending on how you're invested with USA Financial. And what we see here is, with a formula, a way to get in and out of the S&P 500. Now, I will tell you that that line in the background represents the score of this indicator. It does not represent the market itself. And so with a lot of these indicators, in an attempt to be unemotional, like what you see with this one, there's a threshold. The market has to get really bad, or at least the indicator has to get really negative for you to get out of the market. With this particular indicator, if you can find what's the beginning really of 2020, you can see that this long-term indicator almost breaks through the red line. It almost gets negative, but it didn't. And so that short-term crash, which was March of 2020, did not affect this long-term indicator. Talk about being unemotional. This long-term indicator told us to stay invested for the long term during the COVID scare. And if you were using it, it paid off for you. Now, this isn't going to be right all the time. This particular indicator went negative over the weekend. But what it does is it gives us an approach that is unemotional and disciplined. And this approach, in an effort to avoid the catastrophic, gets us out of the market and will get us back in when it deems appropriate. Now, as an advisor, that's really important to me. And this is one of several indicators that we have access to. We have multiple money managers that do things at different times using different formulas that give me as an advisor the confidence to say, you have the chance to avoid the catastrophic. You have the chance to get away from the stock market volatility, not based on how I feel, not based on some of these other charts and graphs that I showed. I showed you the piece about the Fed probability of increase or decreasing interest rates. Well, good news. Just because I showed you that chart doesn't mean I'm moving your money back into the market because of the probability of something happening. My emotions are not determining how you're invested. That's the advantage of sticking to a disciplined, unemotional approach. Now, this approach will not get you back into the market on a day where the market just all of a sudden shoots up. That's not how it's built. It's built to avoid the catastrophic, and based on indicators we've seen, there's a chance that the catastrophic could happen. And so I think it's so important as we talk about monthly formulaic trending, sticking to a plan, not allowing our emotions to distract us or to have us veer off the path. It's important to remember what's the goal, what's the plan, and is this part of the plan? Now, if you stop and think, well, it wasn't part of the plan to lose money in the market. Yes, it was. If you've exposed your money to securities, you have to be prepared to experience loss. Again, active risk management, the way that many of our managers do it, we're trying to avoid catastrophic loss, not all loss. And so if you feel like in the last 2 to 3 weeks you've lost a catastrophic amount, it's time to talk to your advisor. And it's time to make adjustments. But what so often happens when we make these adjustments because we think 10 to 15% is catastrophic, and we move to safety and we feel better, and then the market takes off, and then we don't feel so good anymore. What was the plan when you set it up? Was it a good plan? If it was a good plan 2 to 3 years ago for your long-term money, it's probably still a good plan today. And so let's look at the trend. As we do every month, the charts have changed a little bit, but we look at the last 30 days. And what we see, of course, even with the sharp drop, that sharp drop alone does not indicate a long-term trend. But when we go out to the 1 year, we do see that a trend looks to have taken place. We do look to have had a reversal. And that's why so many of our active managers have moved into a defensive position. Now, as we look at this page, this does, or at least it should, stir some sort of emotion in us. This does look, oh boy, we might be in for it. This is the page specifically that should reassure us about the active risk management strategies our advisors employed. This is where we should be able to say, I get it now. I understand why. Yeah, maybe I didn't get what the market got last year. but we were preparing for a reasonable amount of return in the up market in order to give us a chance to avoid the catastrophic if we see it on the downside. But it's also important to remember that the market doesn't move in a straight line, and that disciplined, unemotional exposure to the market over the long term is still the recipe for success. You can see in 2022, when the market took a steep drop, that if you would have moved to cash after that, you would not have experienced the rise that we've seen in the last 3 years. It's important to understand as we look at the trends in the stock market that if you have a disciplined, unemotional approach to your long-term money, that the movement of the stock market, although we'd never anticipate exactly when it's going to happen, we do plan for it. And so as we wrap up this April of 2025 monthly trending report, it's important to know that the current trends may be negative, but if you have active risk management that is unemotionally filtering data to determine when these trends can turn positive and give us the chance to participate in the upside when the unemotional indicators tell us to, then you should be able to stay the course, trust the plan, and allow your long-term money to experience some of the ride that the market gives to us. This is Kevin Roskam with USA Financial. This has been your trending report in this exciting month of April 2025. Thanks for listening, and we'll see you next month.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.